on a day in which the stock market was massacred, one unsuspecting stock rises above. That's right. H freaking P. The thing you never expected to be leading the market. That's right, baby. You already know what it's doing. Bad boy's up 3% after hours. This stock was positive today. Can you believe it? In a time in which a lot of stocks were down 3%, the whole market was down 3.5%. Well, HP went ahead and said, I don't care about you. I'm very happy with this, though, I must say. HP, of course, one of the most boring stocks of all time, and I think there is no debating that at all. So to see it actually have a positive day in a time in which the market had a very bad day, it's pretty exciting. Obviously, the day before that was not super exciting because, you see that really overall quite a, big decrease on the day. It was prior to their reporting of earnings. So let's take a look at these reporting of earnings. What do these earnings have in store? Why did they go up? Well, you see HP here. They beat on a non-GAAP EPS standpoint by 11 cents per share. So they put up a 65 cents per share number there. And on the GAAP EPS standard standpoint, they put up a 46 cents per share, which beats by 4 cents. Good beat on profit, that is for sure. And revenue, actually down 0.6% year over year, and they missed by $20 million. So they were actually projected to go down in revenue anyways, but overall pretty well in line if you're considering that. So those numbers don't look absurd. You see a good profit line, but then it makes you wonder what is going on here. Why is this stock up quite a bit for a relatively just pretty decent earnings? Well, let's take a look. All right. So HP reports quarter one results, beat estimates. Quarter two outlook sees an EPS of 49 cents to 53 cents versus a consensus of 54. So below consensus outlook, which is obviously means for a stock to go down typically. So again, we're not necessarily there yet. Full fiscal year 20 forecast EPS of $2.33 to $2.43, which is over the consensus of $2.27. So that is good guidance. So for full year, it's quite a good bit of guidance. New strategic and financial value creation plan expects EPS of $3.25 to $3.65 in fiscal year 2022. Are you kidding me? That is significant growth. That is a significant growth over a 3-year period to expect the EPS to rise that much for a company that's been very stagnant. So we'll get into obviously that financial value creation plan. It'll be something we look at today, and I think it is pretty exciting. So I'm very excited to share that with you. So HP increases its share repurchase program to $15 billion, up from $5 billion last October. So that alone is fantastic. And I've talked about this before. Buybacks are a very good thing for a company. If they're buying back their stock, they know it's undervalued and they think they deserve to be higher valued. And they're buying stock while it's cheaper. And if they think that after this stock's gone up quite a bit, I think that's a very good sign. So it'll purchase at least $8 million within the first 12 months after the annual meeting. Well, I think they meant $8 billion. I think that's got to be a typo. $8 million is nothing compared to $15 billion. I mean, Anyways, I think that's a typo. The company aims to return about $16 billion to shareholders during fiscal year 20 to fiscal year 2022. And as far as the Xerox is concerned, HP says the most recent offer is meaningfully undervaluing HP, and says it's reaching out to the company to explore a combination that creates value for the shareholders. That's right. Hey, Xerox. HP is going to hit you with one of the up yours. That's pretty much what they're going to say here. That's what I love, and I can't wait to show you some of these comments here on this. It's exciting. See what they really said about that. There's a little bit more beyond that, but pretty much they're going to say, up yours, Xerox. We're not going out without a fight because this company can stand on its own and we don't need you at all. We don't need you. That's pretty much what HP is saying. And from what I've looked at, I don't think they do. I got to be honest. Xerox is a dying company at this point. I mean, this is a company that, it just isn't there. So let's look at these slides. What am I looking at here? Right underneath this laptop in the left. What is that? Is that a heart made of Play-Doh, or is it a? What is that? There's some spaghetti on there. I'm confused. Let's look at this. So highlights: net revenue $14.6 billion, down 0.6 from prior year. Obviously, we saw that EPS number. Free cash flow of $1.1 billion. Love it. Returned $0.9 billion to shareholders in the form of share repurchases and dividends that quarter. Good for them. So revenues by area, you see printing actually down 6.6% year over year. And honestly, when you think about it, that doesn't shock me one bit. Printing is really, it's not necessarily an area that you would expect to find that much growth in for HP. Not right now, at least. So my main bullish thesis for HP is going to be based around 3D printing. So for the time being, I mean, there's not that many people. If you buy a home printer, you're really not buying anything heavy duty. You're not buying anything. It's going to last you several years too. Just something to consider. But you see, personal systems was increased by 2.4%. So personal systems being computers, desktop towers. That'll be your HP, your laptop, stuff like that. So not a shocker here, but it'd be nice to see that printing business stay at least flat in the meantime. Xerox, obviously they offer a lot more in terms of that printing company, but who needs them? Who needs them is what HP says. So from their net revenue mix, obviously the biggest portion of that revenue is made of notebooks, as in their laptops. Desktops made up 20%. The laptops made up 41%. Printing for commercial hardware took up 7%, but consumer hardware for printing was only 4%. So you see, it's not really a big portion of their business is selling printers to normal consumers. It really isn't. But printing supplies was 21%, and naturally you see that through, it's ink, it's, maintenance cartridges, stuff like that. Revenue by region. You see the Americas is 41% of the revenue. Europe, Middle East, and Africa, 36% of the revenue. Probably a lot of that's in Europe, to be frankly honest. And Asia Pacific and Japan, 23% of the revenue, which actually they grew sales 3% in net revenue. So that's pretty exciting. But from operating profit, you see non-GAAP operating profit of $1.4 billion. And printing made up a higher portion of that. So you see you get a better margin on those printers. That's what it seems like. Overall, you can see this non-GAAP diluted net EPS. It is in a decent trajectory, whereas you see the revenue pretty darn stagnant throughout the time as well. So from Q1 2018, in 2 years, it doesn't look like they've really increased revenue at all, from what you can tell. Not anything too unexpected, because as I told you, this is a very boring company. Very boring company. So from they went from a company of growth to a company over the past year, which has just been pretty darn stagnant. Pretty darn stagnant. Regional revenue trends. You see, obviously, overall in terms of growth, pretty well everything. You see a little bit of a decrease, but Asia Pacific not looking too bad, that's for sure. So for personal systems, obviously notebooks took up 60% of that. Desktops 30%, workstations 6%. Revenue was up 2% year over year for them. Operating profit of $662 million for operating profit from personal systems. So driven by commercial, with a focus on innovation across the portfolio. Love that. Launched new products which include the HP Elite Dragonfly 2, HP Chromebook 11 and 14 models, and the new HP Envy 32 all-in-one. Cool for them. Total units was up 4% in terms of personal systems. Good for them. Notebooks revenue up 1%. Units up 2%. Desktop up 2% and units up 7%. Commercial revenue up 7%. Very good for them. And consumer revenue down 7%. So obviously, as I mentioned, consumers not really where they're going for in terms of, it's just hard to say. Commercials, it's a good sign for them. That's what I could tell you. People buying Chromebooks for businesses, stuff like that. I mean, that's really where they're at for now. As far as printing is concerned, 64% of the revenue is brought through by supplies, 23% in commercial hardware, and 13% in consumer hardware. Consumer hardware was down 13% year over year for them. Total hardware down 10% in terms of units, and supplies revenue was actually down 7% year over year as well. Wowee. So obviously fun stuff. Select cash and debt balances. We like to look at cash and debt. So you see right now they have a little bit more debt than they do cash, but that's nothing insignificant or nothing significant at all. They pay down a little bit of debt, it looks like, quarter over quarter. So really well. Overall they're in a decent position in terms of that. Cash flow, obviously a lot lower. Actually a lot higher this quarter than it was this quarter last year. So that's good to see. You do like to see it. You love to see it, in fact. So pretty much same return to shareholders. A little bit less actually year over year. So that could be something to take a look at. We see this outlook here, which we love. Free cash flow on the outlook of $3 billion to $3.5 billion. Supplemental slides, we don't really care about that much. We want to look at this strategic and financial value creation plan, because this is what the hype is about for people buying into the stock after hours. This is what this hype's about. So they expect to deliver a non-GAAP diluted EPS of $3.25 to $3.26 by 2022. That is crazy. Targeted $16 billion capital returns over 3 years, representing approximately 50% of HP's current market cap. At least $8 billion share repurchases made in the first 12 months. Exactly. And for the Xerox proposal, it's a flawed value exchange, irresponsible capital structure, and overstated synergies. Hey, Xerox. You hear that? Up yours, buddy. Up yours, buddy. That's what they're telling you. Let's go. So under this value creation plan, HP expects to generate $4.7 to $5.1 billion of non-GAAP operating profit in 2022. Fantastic. $10.7 billion to $11.7 billion in cumulative free cash flow in 2020 to 2022. That's like, these numbers are crazy compared to what they have right now. So I really want to know what they're going to do with it. That's crazy. That's just crazy stuff. I'm excited. So, as part of the value creation plan for shareholders, HP's board of directors has authorized a capital return program that will target the return of capital of approximately $16 billion to shareholders. Cool. Expect implementation of the capital at least $8 billion in the first 2 months. We already know that. Okay. We already know what's going on here. Increasing its target long-term return of capital to 100% of free cash flow generation. Unless higher return opportunities emerge. Intends to maintain dividend per share growth, at least in line with earnings. Good for them. Maintaining an investment grade rating, targeting gross debt to EBITDA ratio of 1.5 to 2 times. Good deal. HP recently announced a cost reduction program that is expected to result in $1.2 billion of gross annualized run rate structured cost savings. So that's where a lot of that money's coming from in free cash flow. with additional ongoing productivity improvements of at least $1 billion. That's where that free cash flow is coming from. HP today announced that it expects approximately $650 million of these structural cost savings flow through the projected non-GAAP operating profit growth. Crazy. So for the Xerox proposal, it meaningfully undervalues, creates significant risk, and compromises the future of HP. Up yours. What can you say? What can you say? Up yours, buddy. HP is the market leader in print with 40% unit share and the highest operating margins in the industry. That's good. Obviously, they already have that. Is establishing a long-term target operating margin range of 16 to 18%. HP is executing a consistent strategy to evolve its print business model to deliver greater choice, convenience, and value to the customer, and increasing its recurring nature of print revenue. Recurring, okay. And that's where a lot of people make consistent money. It's services that result in recurring revenue. This executing on its playbook to increase share in supplies, continue to grow contractual revenues to consumers, or in consumer and enterprise, optimizing system profitability to rebalance system value towards hardware, and growing its graphics and 3D portfolio, 3D, to lead the analog in digital transformation. That is what I'm talking about. In 3D printing and digital manufacturing, HP's decades of innovation investment have created new businesses for the company and established a strong track record of growth by monetizing its highly differentiated IP. HP is extending beyond hardware to transform manufacturing and build complete solution ecosystems to capture substantial market opportunity and unlock new sources of revenue. Let's go. We love that. And obviously you see HP has beat or met non-GAAP EPS guidance for all 17 quarters in a standalone company, or as a standalone company. So guess what? The fact that they're giving this announcement actually means quite a lot, that they're announcing in 3 years they're going to be at a certain point, because they've been consistently hitting the numbers they say. That's crazy. That's crazy. That's all I can tell you. Over the last 3 years, HP has grown revenue by $10.5 billion over the last 3 years. That's right. Grown GAAP diluted EPS by 45%, generating $12.9 billion in cumulative cash flow from operations, and returned $9.1 billion to shareholders. That is what I'm telling you. So, obviously, they plan on disrupting industries with breakthrough technology across graphics and 3D printing and digital manufacturing, and showing the way it works. Let's go. So that's it for HP earnings. This stock, I think it's fair to buy. I know it's crazy. Because this stock is a boring stock, and it's proven me to be boring historically. But I think I believe this company and what they're actually giving as far as this guidance is concerned. And if they hit these numbers, this company is actually going to turn into a growth company, and it's going to be super exciting. I can't wait to see it, and I hope you enjoyed.